All right, let's reset for a second. If you're multitasking, stop. If you're scrolling, don't. What I'm about to explain is not background noise, and it's definitely not just another silver is up story you all forget by tomorrow. What has unfolded in the silver market over the last 3 days is something far more serious, far more structural, and frankly, far more revealing about how fragile the entire system has become. What we re-witnessing is not a rally fueled by hype or a speculative breakout driven by retail enthusiasm. This is the moment when decades of carefully managed illusion finally ran headfirst into physical reality. And reality, as it turns out, doesn't negotiate. It snaps things in half. That sound you hear in the background of global markets right now, that low, grinding crack, is the paper silver market losing its grip on the physical metal it was supposed to represent. As of right now, silver is trading around $84 an ounce. This isn't a bull market in the traditional sense. This is a reckoning. This is the end stage of a multi-decade suppression structure that is now being overwhelmed by forces it can no longer contain. And the timing matters. January 2026 will be looked back on as the dividing line between the before era and whatever comes after. Once you cross this threshold, there's no rewind button. The system doesn't reset. It adapts or it fractures further. Let's start where the truth usually reveals itself first, the chart. Because market structure doesn't lie, even when narratives do. Silver spent years trapped inside a massive consolidation range, a cage reinforced by repeated failures near the 2011 highs. Every attempt to break out followed the same script. Price rises, optimism builds, then suddenly, slam. Massive futures selling, algorithmic stop hunts, cascading liquidations. Retail gets shaken out, confidence dies, and the price is marched back down. Rinse and repeat. This cycle ran for over a decade, until it didn't. On January 9th, silver was violently pushed down to the low 70s. It was fast, aggressive, and very deliberate. Textbook bear trap. The goal was simple: flush week longs and bait fresh shorts. Stops were triggered, leverage was destroyed, and new short sellers stepped in convinced, once again, that the breakout had failed. They sold at $74, then $75, thinking they were early, thinking they were smart. History, they assumed, was on their side. Sunday night proved them very wrong. When markets opened, silver didn't ease higher. It gapped, straight from the high 70s into the low 80s without trading in between. That's not enthusiasm, that's panic. A gap like that means buyers were so aggressive and sellers so scarce that price had to jump several dollars just to find resistance. This isn't how calm markets behave. This is what happens when someone realizes they waited too long. From there, the price action told a very specific story: sharp vertical moves, brief pauses, then another surge higher, over and over. No wild swings, no emotional whipsaws, just controlled, relentless accumulation. That pattern doesn't belong to retail traders. It belongs to institutions, sovereign entities, and players who don't care about a one-week chart because they repositioning for something much bigger. Then New York woke up. At 8 a.m. Eastern, the algorithms finally registered what had happened overnight. They compared prices across global exchanges and immediately flagged a problem, a massive one. The arbitrage between Western paper prices and Eastern physical markets was blowing out. And when machines designed to exploit inefficiencies realize the inefficiency can't be closed, they stop waiting and start chasing. Volume exploded. Silver ripped through $84 like it wasn't there. $85 printed. And here is the detail most people miss. The final candle of that move closed at the absolute high. No upper wick, no profit taking, no selling pressure. In technical terms, that's as aggressive as it gets. Everyone who wanted silver wanted it now, and nobody was interested in handing it over. That brings us to $85, which isn't just another psychological level, it's a financial pain threshold. This is where commercial shorts, banks, and institutions that have carried massive short exposure for years stop worrying about losses and start worrying about survival. Anyone who sold silver short in the mid-70s is now deeply underwater. Multiply that by position size, and you're not talking about bad quarters, you're talking about balance sheet risk. Naturally, they're trying to push back. There are attempts to force a pullback, to engineer a healthy correction, to shake out late longs. That playbook used to work. The problem is that the physical market has stopped playing along, and that's where Shanghai enters the conversation. While Western traders obsess over New York price action, the real fracture is happening between East and West. For decades, silver was treated as a globally fungible commodity. An ounce in New York was supposed to be worth roughly the same as an ounce in Shanghai. If prices diverged, arbitrage traders would step in, move metal, and close the gap. That mechanism kept the system stable. That mechanism is now broken. As of now, silver in New York trades around $84. In Shanghai, it's over $93. That's a spread of more than $9 per ounce. On paper, that's free money. Buy cheap, sell expensive. The easiest trade imaginable. Except no one is doing it, not because they don't want to, but because they can't. The metal isn't available. Comex inventories are depleted. Registered silver is sitting near historic lows. The 1,000-ounce bars required to close that arbitrage simply don't exist in sufficient quantity. And even if they did, there's another obstacle. China gasps new export licensing rules that went live on January 1st. Metal can flow into China, but it doesn't flow back out. Once silver enters the Chinese system, it's effectively trapped. That wasn't a coincidence. It was a strategic decision. China has turned silver into a controlled resource, locking up supply to protect its industrial base, and, intentionally or not, breaking the global pricing mechanism. The old bridge that kept prices aligned between London, New York, and Shanghai has been severed. What we now have are two markets with two prices, and the West is chasing the East. For decades, China was a price taker. They paid whatever the paper markets dictated because they needed the metal. Solar, electronics, batteries, you name it. Today, that relationship has flipped. Shanghai is setting the price, and New York is reacting. This shift didn't happen overnight, and it didn't happen for one reason. It's the convergence of multiple forces hitting at the same time. Structural supply depletion, industrial demand that doesn't care about price, strategic stockpiling, and a paper market that promised more metal than it could ever deliver. That's why this moment matters. Not because silver went up $10, but because the illusion that kept it contained just cracked wide open. And once a market starts pricing reality instead of promises, things tend to move very fast. A little humor before we wrap this part up. The people who spent years saying, silver is manipulated, but it doesn't T-matter, are suddenly very interested in why it matters now. Funny how that works. The game has changed. Not tomorrow, not someday. Now. And the people who understand that aren't a T-chasing headlines, they repositioning themselves on the right side of a structural shift that only happens once in a generation. To really understand why this move in silver isn't fading, you have to stop looking at price charts alone and start looking at pressure. Real, unavoidable pressure coming from multiple directions at once. This isn't speculative excitement. This is demand that doesn't care what the price is, doesn't wait for pullbacks, and doesn't respond to paper games. Start with industrial demand, because this is the foundation and it's completely inelastic. China is the engine room of global manufacturing. They don't just lead the world in solar panel production, they dominate it. Same story with batteries, electronics, and advanced manufacturing. Every one of those processes consumes silver, and not in a nice-to-have way. You cannot engineer silver out of a solar panel. You cannot replace it with software, good intentions, or press releases. If you want the product, you need the metal, period. What's changed is how Chinese manufacturers think about inventory. For years, they ran lean, just-in-time delivery, minimal stockpiles, maximum efficiency. That model died during the supply chain chaos of the last few years, and nobody in China wants to relive that nightmare. So they flipped the script. Now it's just in case. Stockpile first, worry about cost later. Because the cost of not having silver isn't financial, it's existential. If factories stop because raw materials aren't available, the economic fallout becomes political, and political problems are the only problems that really matter. So they buy. At 80 oscillars, at $90, at $100. Price is irrelevant. Ounces are everything. That alone puts a hard floor under physical silver that paper markets simply cannot break. Then layer on currency stress. The yuan is weakening, the property sector is imploding, domestic confidence is eroding, and Chinese citizens, like people everywhere when trust breaks down, are looking for exits. But unlike Western investors, they can't just wire money abroad or pile into dollars. Capital controls block that door, so they turn to what's available and historically trusted, gold and silver. This isn't speculation, it's self-defense. Millions of individuals quietly converting paper savings into metal because they understand something fundamental. Currencies fail, metals endure. That internal monetary demand stacks on top of industrial demand, and together they form a bid that doesn't sleep. Now add resource nationalism. We are no longer in a globalized world where materials flow freely and politics stay politely out of the way. We've entered an era where supply chains are weapons. Countries know that whoever controls strategic resources controls manufacturing, technology, and leverage. China isn't just accumulating silver, they're accumulating copper, lithium, rare earths, anything critical to the modern economy. Strategic stockpiles are being built deliberately, quietly, and aggressively. This isn't market behavior. This is geopolitical positioning, economic warfare without uniforms. And silver sits right in the middle of that battlefield. Bring this back home, because here's where the illusion really starts to fall apart. While the paper price in New York struggles to keep up with Shanghai, the physical price in the United States has already caught up, and passed it in some cases. Look at the math. Spot silver sits around $84. That's the number on the screen. But try to actually buy silver. Not an ETF, not a futures contract, not a promise, real metal. Silver eagles, maples, rounds. You're paying spot plus premium, and premiums have exploded. $9 an ounce on average, sometimes more. That puts your real cost right around $93 an ounce. Sound familiar? It should. That's Shanghai pricing. The physical market has already converged globally. Only the paper screen is lagging behind, and screens don't hold metal. Receipts do. And here's where it gets uncomfortable. Availability is vanishing. I've spoken directly with people inside major private mints, the companies that take those large industrial bars and turn them into the coins investors actually buy. Delivery times are now stretching to 8 weeks. That's not logistics. That's supply failure. It means they don't have the bars. They're taking orders today and hoping they can source metal later. That's not inventory. That's faith. One senior executive at a major U.S. bullion dealer summed it up perfectly when I asked about supply. He said, "Nobody has any silver. That's it. No drama. No spin. Just reality. And if buying continues at this pace, premiums won't stay at $9. They'll jump to 20, 30, maybe more. At that point, even if paper prices are smashed down, physical buyers won't feel it. A $70 spot price with a $50 premium still puts you at $120 an ounce. You can't print silver. You can't short a silver eagle into existence, and you definitely can't talk your way out of a physical shortage. This is the fraud of paper price discovery being exposed in real time. Investors who see it aren't waiting for permission from COMEX charts. They're buying what they can, when they can, because they understand availability disappears before price fully adjusts. Now zoom out even further, because dollars are a terrible measuring stick in a world where currencies are unraveling. If you really want to understand where silver stands, you have to measure it against gold. For thousands of years, the natural monetary ratio between gold and silver hovered around 15 to 1. That ratio reflected geological abundance, monetary use, and economic reality. In the modern era, that relationship was distorted. Silver was demoted to just an industrial metal while gold retained its monetary status. At times, the ratio blew out beyond 100 to 1. That wasn't natural. That was engineered. Look at today. Everyone's watching $100, and for good reason. Triple digits flips a psychological switch. Media attention explodes. Investors who never cared about silver suddenly care a lot. Fear of missing out takes over. We saw this movie in 2011 when silver ran to $50. The difference is that back then the move was fueled by speculation and momentum. The fundamentals were weak. This time, the fundamentals are ironclad. Physical shortages, broken arbitrage, strategic hoarding, currency erosion. When silver crosses $100 this time, it won't signal the end, it will signal recognition. And then there's the Federal Reserve, stuck in a box with no clean exits. The global system is built on the idea that U.S. treasuries are risk-free. They anchor everything, stocks, real estate, derivatives, all of it. But when gold and silver surge, they expose the weakness of fiat currencies. Investors sell bonds to buy real assets. Yields rise, valuation models break, stocks reprice. The Fed has two options. Print money to suppress yields and save markets, which destroys the currency and sends metals vertical. Or don't print, let yields rise, let markets crash, and trigger a depression. Either path drives capital out of promises and into reality. There is no third door. And just to make things even messier, confidence in the central bank is eroding further with legal scrutiny now entering the picture. Trust is fragile. Once it cracks, it doesn't come back easily. That's where we are. Not at the end, but at the moment where the truth stops being ignorable. Silver isn't moving because traders are excited. It's moving because the system it was trapped inside is failing. And markets don't forgive denial. They punish it. What we are watching now is the acceleration phase. The part of the cycle where capital stops debating and starts fleeing. Money is leaving abstract financial promises and moving toward things you can actually touch. That shift could not be happening at a worse time for the institutions that built their power on paper assets, and it could not be happening at a better time for anyone who already understands silver. So the real question becomes, what now? How do you navigate what comes next without getting shaken out, mispositioned, or tricked into giving up the advantage you've built? The first thing to understand is that not all silver exposure is the same, even if it looks the same on a brokerage statement. There's a massive difference between owning silver and owning a claim on silver. Paper products, ETFs that promise cash settlement, derivatives, unallocated accounts, are built on trust. They assume the system will function normally at the exact moment when normal is no longer guaranteed. That's a dangerous assumption. If there is a disruption, those products don't give you metal. They give you dollars. And dollars in this environment are the very thing people are running away from. The safest exposure is boring, old-fashioned, and slightly inconvenient. Physical silver in your possession or in fully allocated storage you control. Yes, premiums are high. Yes, storage requires planning. But you remove counterparty risk entirely. You own the asset that everyone else is scrambling to secure. If physical ownership isn't practical, the next best alternative is something tightly linked to the physical market, like PSLV, which is audited, transparent, and has a redemption mechanism for large holders. It's not perfect, but it's far closer to real metal than most paper vehicles. What you want to avoid are products that quietly reserve the right to settle in cash during market stress. The clause might seem harmless until the day it matters. Being forced to accept paper at a broken paper price while physical trades at a massive premium is how upside gets stolen. The second pillar of strategy is your exit, and this is where most people get it wrong. The goal is not to sell silver for more dollars. Dollars are the problem, not the prize. The real objective is to eventually exchange silver for other hard assets when ratios shift dramatically in your favor. Land, income-producing real estate, businesses, energy infrastructure, productive things that generate cash flow and utility. Think in ratios, not prices. Today, it might take thousands of ounces of silver to buy a home. At the peak of a precious metals cycle, that number can collapse. 5,000 ounces becomes 500. That's the trade. You are not speculating. You reconverting one form of durable wealth into another while bypassing the currency system entirely. Unless you have an immediate expense, trading silver back into fiat misses the point. The metal is the bridge. The destination is productive assets. The third thing you must prepare for is volatility, because the path forward will not be smooth or polite. The road to $100 silver is not a straight line. It's violent. There will be days where price drops $5 in an hour. Those moves are engineered. They exist to liquidate leverage, to scare weak hands, to create headlines that say, bubble burst, when nothing's structurally changed. If you're using margin, those moves can wipe you out if you're holding physical metal or unleveraged positions. They're just noise. In fact, they often create opportunity. Because here's the key distinction. When paper prices drop, the physical market doesn't follow, premiums expand, availability tightens, the all-in cost stays high. Smart money uses paper dips to acquire what little physical supply remains. If you want to compass through the chaos, watch the gold to silver ratio, not the dollar price. The ratio tells you where you are in the cycle. Right now, we're still above 50 to 1. In 2011, the ratio compressed to around 30. In 1980, it hit 15. Until we see sustained movement below 30, this bull market is still young. There's a lot of road ahead. The second signal to watch is the Shanghai premium. As long as silver trades higher in Shanghai than in New York, there's a gravitational pull lifting Western prices. That spread is the proof that physical demand is overwhelming paper supply. When the spread finally closes, the catch-up phase is complete, but we're nowhere near that point. The spread is widening, which tells you demand in the East is accelerating faster than the West can respond. The third signal is availability. This is the most important and the least discussed. We are reapproaching what I call the unobtainium phase, the moment when silver cannot be purchased at any price. As industrial panic accelerates, refiners will prioritize strategic clients. Allocation limits will be imposed, retail supply will be cut off. Companies like Tesla, Samsung, and defense contractors will get first access. Individual investors will be last in line. When that happens, the buy button disappears from bullion websites. The screen price becomes meaningless because there's nothing to buy. If you're sitting in cash waiting for the perfect pullback, you may discover that the dip arrived in a market that closed its doors. And let me be very clear about timing. We are already in the acceleration phase. The move from $20 to $30 took months. The move from $70 to $85 took days. The next leg, from $85 to $100, could take hours. That's how parabolic moves behave. Time compresses. Each new high creates urgency, fear of missing out, forced buying from trapped shorts, and algorithmic momentum chasing. Once that loop starts feeding on itself, timing entries becomes impossible. You either have exposure or you don't. Now, I want to talk directly to the people thinking about selling right now. You're looking at your account. You're seeing gains that feel unreal. You're thinking about locking it in. That instinct is human, but understand what the trade actually is. You're selling a scarce, strategic, real-world asset to buy a paper claim being diluted daily to fund the very crisis driving silver higher. It is like selling the lifeboat to buy a first-class ticket back onto the Titanic because the lounge looks calm. You're also handing your position to institutions at the exact moment they're desperate. Don't be their liquidity. Don and T sell them silver at 85 so they can ride it to 200. Make them pay. They had years to buy at $20. They didn't. That's not your problem. Institutions are late, they're underweight. And that creates career risk. When portfolio managers sit in front of their risk committees and explain why they missed the best performing asset of the year, excuses won't save them. Career risk is stronger than greed. The mandate will be simple. Get exposure now. Here's the problem for them. The silver market is tiny. A single large pension fund allocating 0.5% to silver is larger than the daily liquidity of the entire futures market. It's like trying to force Hoover Dam through a garden hose. The hose doesn't slowly stretch, it bursts. When that capital arrives, price won't climb politely. It will gap. It will dislocate. What we saw over the last 72 hours wasn't the main event. It was the rehearsal. Junior traders, algorithms, thin holiday liquidity. The real buyers, the captains of capital, are still on vacation. They're seeing alerts on their phones. They're uneasy, but they can't act yet. When they return to their desks and try to deploy billions into a market measured in millions, what follows will make recent moves look tame. Expect gaps of $10, $20. Expect limit up days. Expect moments where trading halts because the system can't process the demand. This isn't random. The alignment of a technical breakout, a broken global arbitrage mechanism, and a physical supply crisis is a historic signal. The old regime is finished. There is no path back to $20 silver. That world is gone. The forces at work now are too large, too structural, and too global to be suppressed by paper games. Cheap silver was a policy choice. That policy has failed. The opportunity here is generational, but the window is closing. Every day, more metal disappears. Every day, premiums rise. Every day, availability shrinks. You did the hard part early. You understood the setup when it was boring. You positioned before the headlines. Now comes the hardest part of all, holding. Don't let fake sell-offs, engineered fear, or psychological warfare shake you out. You are holding one of the few assets that actually matters in a world coming apart at the seams. The $100 wave is coming. And when it hits, silver will never be perceived the same way again. The paper era is over, the physical market has taken control, and the repricing has only just begun.